Long-term yields are back at levels we have not seen in nearly 2 decades, yet the S&P 500 is still hovering near its highs and AI earnings are exploding. That tension between higher discount rates and powerful growth stories is where the equity market risk lies today. Welcome to vTalkInsight, Equity Pulse Daily for August 3rd, 2026. Global equities are trading against a backdrop of long-term Treasury yields at their highest levels in almost 20 years. The 30-year is back near levels last seen in 2007, after 5 straight weeks of rising long-end yields. That move reflects a mix of persistent inflation running above target, heavy Treasury and global sovereign issuance, a shrinking Federal Reserve balance sheet, and growing doubts about how far the Fed is willing to go. Markets are increasingly treating this as a structural shift away from the ultra-low rate regime of the 2010s, not just a temporary spike. These higher long-term rates are tightening financial conditions even before the Fed takes its next step. Mortgage rates are moving higher, housing and other rate-sensitive assets are feeling pressure, and small-cap equities are underperforming as financing costs rise. At the same time, some investors see current fixed income yields, especially at the front end, as attractive compensation and expect 10-year rates to be broadly stable into year-end unless there is another major inflation surprise. That tension between tighter conditions and perceived value in yields is central to how risk is being priced across equities. Recent labor cost data has pushed the rate debate back to the forefront. The employment cost index rose 0.9% in the second quarter, above expectations, sending bond yields higher and triggering an equity pullback. Short-end Treasury yields climbed as markets reassessed the odds of further tightening. Many participants now expect a series of incremental Fed hikes, with some looking for as much as 75 basis points over coming meetings and others flagging the possibility of a 50 basis point move as early as September, if inflation does not cool. Inside the Fed, dissenting voices are becoming louder, with Neel Kashkari among those arguing for gradual but continued hikes to avoid inflation becoming entrenched. In contrast, houses like UBS think the central bank is likely to stay on hold for the rest of the year, viewing the recent pause as appropriate. Despite that policy uncertainty and rising real yields, equity indices have been resilient. The S&P 500 is roughly flat on the month and still close to all-time highs, helped by strong earnings and the view that projected 24% earnings growth in 2026 is relatively insensitive to interest rates. The next rounds of inflation and wage data, together with communication heading into the September meeting, will be critical for where this balance breaks. The volatility picture is being reshaped as the Fed steps back from explicit forward guidance. Policymakers are leaning on their dual mandate of price stability and full employment, but offering fewer hard signals on the future path of rates. That has pushed investors to trade each incoming data point and every regional Fed speech more aggressively, increasing volatility along the yield curve and lifting the term premium embedded in long-end yields. The perception that the Fed's reaction function is opaque is also eroding some of its credibility, making asset pricing more uncertain. Interestingly, index-level volatility still looks contained. The VIX is sitting in the mid-teens, and surface-level measures suggest calm. But beneath that, dispersion is high, particularly in technology and memory chip stocks, and small caps are lagging sharply. Volatility strategies have been outperforming, and demand for hedging has risen, even as headline indices appear stable. The combination of rising structural rate volatility and sector-level swings is pushing markets toward a more idiosyncratic, stock-picking environment. This environment is reviving interest in active management and alternative weighting schemes over simple market cap passive indices. Elevated volatility and divergence between major stocks and sectors are making static index exposure feel less comfortable. Flows underscore that shift. Hedge funds have recently been net buyers of equities while retail investors have been significant net sellers. At the same time, institutional capital is accelerating into private credit and alternative strategies where spreads have widened. If rate volatility and policy ambiguity persist, that tilt toward active risk-taking and alternatives is likely to remain a defining feature. Against the macro noise, the corporate earnings engine remains powerful. S&P 500 earnings growth this quarter is running at about 47% year-on-year, marking a fourth straight quarter of beating already high expectations. Looking further out, earnings for 2026 are projected to grow around 24%, a pace usually seen only in the aftermath of major recessions or crises. That strength has allowed some valuation multiple compression even with indices near highs, supporting the idea that current price levels are being underpinned by genuine earnings power rather than pure re-rating. Sector leadership is also broadening. Financials are emerging alongside technology and industrials as favored areas, helped by improved earnings revisions, increased share buybacks, and stronger capital markets activity. Major U.S. banks report that investments in blockchain and digital innovation are positioning them for benefits from 24/7 trading, instantaneous settlement, and lower transaction costs. That speaks to a structural profitability story that goes beyond the immediate boost from higher policy rates. In Europe, bank earnings have been a clear bright spot. Crédit Agricole delivered record second quarter revenues of €7.4 billion, up nearly 8%, with strong contributions from retail, asset management, and investment banking, and a cost-to-income ratio below 55%. Its asset management arm, Amundi, achieved record profits and inflows, enabling an interim dividend in October. NatWest beat expectations, raised full-year guidance, is considering accelerating share buybacks, and is integrating Evelyn Partners, creating the UK's largest employed advisor network and a stronger private banking franchise. Across the region, retail-focused banks have largely beaten on revenues and cost of risk, even if U.S. peers still dominate trading market share. Energy producers add another pillar to this earnings story. Chevron reported its highest quarterly profit in at least 6 years, with record U.S. production, record refinery throughput, and global output up 20% year-on-year. The Hess acquisition is delivering about $1.5 billion of synergies, well ahead of plan, and Guyana is becoming a major growth driver. Management has prioritized debt reduction and balance sheet strength over aggressive new investments, reinforcing a disciplined capital allocation message. Taken together, strong results from financials, energy, and select industrials help offset concerns about narrow dependence on a handful of mega-cap tech names. The AI complex remains the most powerful, but also the most contested part of the equity story. Recent earnings show that markets are drawing a sharper line between disciplined, monetizable AI investment and speculative spending. Amazon and Microsoft are the clearest beneficiaries of that distinction. Amazon's AWS business just posted 37% year-on-year revenue growth, its fastest pace in several years, with margins expanding well above consensus expectations. Management sees a path for AWS revenues to eventually approach $1 trillion, with capacity expected to double by the end of 2027, yet still be constrained by demand. AI-related revenues at AWS have already reached a roughly $2 billion run rate, while non-AI cloud demand also remains strong. Despite that, Amazon stock still trades at a rare discount to the S&P 500, underlining how skeptical markets have become about paying for long-duration growth without clear cash flows. Microsoft, Alphabet, and Meta are all accelerating AI infrastructure investment as well. Google Cloud's growth has re-accelerated to 63% year-on-year, and Microsoft's large base of paid enterprise users provides significant runway, since only a small fraction have adopted Copilot so far. Where hyperscaler capex is tightly linked to visible customer demand and revenue, equity markets continue to reward it. The flip side of this enthusiasm has been a painful unwind in crowded AI trades. A heavily leveraged AI-focused hedge fund saw its assets plunge from about $45 billion to $10 billion within days after a sharp decline in AI stocks triggered margin calls and forced selling. That stress rippled across other funds holding similar positions, as banks demanded more collateral, prompting broader de-risking and liquidation of both public and private holdings. Record outflows from technology and semiconductor ETFs and hedge fund deleveraging in hardware and software exposures have underscored the risks of concentration and leverage in thematic trades. Citadel has emerged as a key buyer in this dislocation, acquiring large public stock positions from the distressed fund at discounted prices. Its ability to absorb billions of dollars of inventory in volatile conditions highlights how market influence is concentrating in a handful of large multi-strategy platforms. Paradoxically, the foreselling may have improved the technical backdrop for parts of the AI complex. Positioning in chip stocks has been cleaned up, and combined with strong structural demand, that creates scope for a more constructive setup if fundamentals continue to deliver. Financing the AI build-out is another pressure point. Digital infrastructure capex from hyperscalers, now exceeding an estimated $750 billion, is straining credit markets, widening spreads, and slowing project deployment. Oracle's widening credit spreads and more expensive credit default swaps reflect investor concern about debt levels and the pace of monetization. In contrast, private credit managers like Ares are reporting record fundraising of over $36 billion, low non-accruals below 2%, and high single-digit cash flow growth. Ares is targeting large, pre-leased data centers in Tier 1 markets with long-dated escalator contracts, while deliberately avoiding riskier secondary and frontier projects. That split shows AI as both a powerful growth driver and a source of capital structure and liquidity risk. Energy has returned as a major macro swing factor. Brent crude has risen about 20% this month and is trading near the high 80s to above $90 per barrel, driven by renewed Middle East tensions and supply disruptions. Refinery capacity is running at or above 100% in many regions, with some Russian capacity offline, creating bottlenecks in delivering petrol and diesel. That tightness is pushing pump prices higher even when crude benchmarks pause. The disconnect between crude and pump prices reflects the importance of refining constraints and key maritime choke points. Exxon has warned that a prolonged closure of the Strait of Hormuz through the third quarter could disrupt as much as 750,000 barrels per day of its production. Until global refining capacity is restored, inventories are rebuilt, and key shipping routes are fully reopened, elevated pump prices are likely to persist. That prolongs the inflationary impulse from energy into the broader economy. For equities, this creates a two-sided effect. On one hand, higher fuel and transport costs reinforce the case for persistent inflation and higher for longer interest rates, which weigh on rate-sensitive sectors. On the other hand, producers like Chevron are clearly benefiting, reporting record cash generation and using it to reduce leverage. Exxon, which lagged recently due to higher maintenance costs, expects those headwinds to fade in the third quarter, which should allow it to capture more of the upside from elevated prices. Energy equities are thus both beneficiaries of the current macro mix and a channel through which that mix feeds back into inflation expectations and rate markets. Looking beyond mega-cap tech and large financials, micro-level signals show a nuanced picture of demand and execution risk. In consumer, Jersey Mike's has delivered 20 consecutive years of positive same-store sales, with recent quarters showing sequential improvement and the second quarter exiting at about 2.3% growth driven mainly by traffic. The company plans to use IPO proceeds primarily to reduce leverage below 4.5 times EBITDA, with a longer-term strategy focused on returning capital. That combination of steady demand and balance sheet discipline is a recurring theme across resilient consumer franchises. In healthcare and life sciences, fortunes are diverging. Illumina, a key player in genomic sequencing, has seen its shares rise nearly 50% over 6 months on strong quarterly results and a slight upgrade to full-year guidance. Clinical applications now account for more than 65% of its consumer business, growing in the teens, and the integration of AI with large genomic datasets positions it squarely in the emerging bioinformatics landscape. By contrast, Novo Nordisk suffered a sharp share price drop of nearly 8% after an experimental anti-inflammatory drug failed to reduce cardiovascular risk in late-stage trials, undermining ambitions to expand beyond its core obesity and diabetes franchises. Media and gaming also show the cost of disappointment. Universal Music Group is down around 37% year-to-date after 2 consecutive quarters of earnings misses and weaker than expected subscription revenue growth. Roblox fell 26% following analyst downgrades and a more than 50% cut to its price target on ongoing monetization concerns. On the positive side, Monolithic Power Systems gained over 8% after beating earnings expectations and guiding revenues above consensus, driven by expanding exposure to data center infrastructure. These moves underline how, in a market defined by higher rates and elevated dispersion, clear earnings delivery and credible guidance are being rewarded while any crack in the story is punished quickly. Pulling this together, equities are balancing a powerful earnings cycle and AI-led growth against a clear regime shift in rates and energy. Long-term Treasury yields are back at multi-decade highs. The Fed's reaction function is less transparent, and oil has reintroduced an inflation risk premium, all of which tighten financial conditions. Yet earnings breadth is unusually strong, from U.S. and European banks to energy majors and select industrial and technology names, and the S&P 500 remains near its highs. Within tech, markets are rewarding disciplined AI capex and visible monetization at companies like Amazon and Microsoft, while forced deleveraging in crowded AI trades and financing stress in parts of digital infrastructure are exposing where leverage and weak business models sit. For equity allocators, the balance of risk now turns on whether higher real yields settle, how the Fed addresses September without further damaging credibility, and whether current earnings strength in financials, energy, and quality growth can keep offsetting pressure on long-duration assets. Watch upcoming wage and inflation data, Fed communication, oil supply developments, and ongoing earnings revisions across AI, banks, and energy as the next set of catalysts. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.